What if I told you the biggest mistake people make in a recession is not losing money? It's being unprepared when the real opportunity shows up. Because recessions don't just crash markets, they quietly transfer wealth from the unprepared to the patient. Let's break this down simply. My latest macro outlook for 2026 points toward a potential war-driven recession, not your typical slowdown, but one shaped by geopolitical tension, energy shocks, and aggressive government spending. And that changes the game completely. Most people think recessions are just about charts going down, but that's surface-level thinking. Recessions actually do three things. They destroy purchasing power, they expose bad financial habits, and they reward discipline. While everyone focuses on price drops, smart players focus on survival first, because if you're not solvent, you can't take advantage of anything later. Now here's where it gets serious. The expectation is that markets like the S&P 500 could revisit significantly lower zones, potentially much lower than where people feel comfortable today. And here's the key insight. By the time a recession is officially announced, markets have already fallen. So waiting for confirmation? So what actually works in this kind of environment? First, or cash becomes extremely important, not because it grows, but because it gives you options. Second, focus shifts to defensive sectors, things people must use no matter what. Healthcare, basic consumer goods, utilities. These tend to hold up better when everything else struggles. Now let's talk about something important. Gold. Historically, gold doesn't crash as hard as stocks, and it often recovers much faster. In many past downturns, it has even gone on to make new highs while equities are still trying to stabilize. That's why it's seen as a store of purchasing power, not just an investment. But this time, there's a twist. This is likely a war-driven recession, which means certain sectors suddenly become critical. Energy, fertilizers, rare earth materials. These are no longer just industries, they become national priorities. And here's the pattern. Early phase, cash dominates second phase. Hard assets and energy move first. Because once governments start printing money again, capital flows back into scarce, real-world resources. Now this is where most people fail. They panic, they over-leverage, or they keep spending like nothing has changed. But the smarter approach, reduce unnecessary risk, avoid flashy consumption, slowly accumulate quality assets as they get cheaper. Think long-term positioning, not short-term excitement. Because at the end of the day, recessions are not just periods of loss, they are windows of opportunity, but only for those who stay liquid, stay patient, and stay disciplined. The question is simple. When that window opens, will you be ready or watching from the sidelines?